Morrisons announced on Thursday that it would close 100 convenience stores, blaming labor policy for what it called significant cost increases that made profitability impossible to recover. That headline framing is partly a political choice. The Financial Times reported those sites had been loss-making for years before the current government took office. But the part that matters for investors is not who bears the blame. It is what the closure reveals about the arithmetic of UK retailing right now. Morrisons carries £3.1 billion in net debt from its 2021 leveraged buyout by Clayton, Dubilier and Rice, and that debt burden was already forcing asset sales before any new tax arrived. With the national insurance contribution hike and the extended producer responsibility packaging levy was removed the margin for error on borderline sites. The mechanism is straightforward. Retailers operate on thin margins, convenience formats operate on thinner ones still, and when employer costs rise faster than the ability to raise prices, the weakest sites cross into structural loss. Retail investors holding consumer staples for dividend income are now watching the government's price cap pressure. Reeves asked supermarkets this week to cap milk and bread, collide directly with the cost mandates that are closing stores. That collision is not resolved by cutting tariffs on 100 food categories, which the Chancellor announced Thursday. It is a structural cost problem on the labor and packaging side that tariff relief at the import margin does not touch. The redundancy data reinforces the directional signal. Some 56,396 jobs were flagged for potential redundancy in the first 2 months of 2026 alone, 9% above the same period last year, with lawyers already advising clients to preemptively restructure before the January 2027 Employment Rights Act deadline removes the current unfair dismissal cap. Capital is not flowing into UK consumer names that face this cost curve. It is rotating out, with domestic institutional buyers largely watching rather than absorbing. The Morrisons situation does not simply describe one supermarket's balance sheet. It names the structural pressure point sitting beneath every FTSE 100 income name with a high labor cost ratio. What it leaves open is whether any domestic consumer company has the pricing power or brand premium to offset this cost structure, or whether the relief, when it comes, arrives from outside the domestic economy entirely.
Diageo shares have recovered roughly 15% from their recent lows, and the proximate trigger is a trade concession that had nothing to do with the company's own management decisions. When Donald Trump, following the King's state visit, removed all tariffs on Scotch whiskey entering the United States, the move cut directly into one of the main demand-side headwinds that had compressed Diageo's outlook since 2025. The U.S. is Diageo's largest single market for Johnnie Walker, and the tariff removal lifted the price competitiveness of a brand in the world's highest value spirits market without requiring the company to absorb any margin sacrifice itself. That asymmetry, external relief with no internal cost, is what separates this recovery from the retail picture in Chapter 1. Diageo's problem was never the cost structure of making Scotch. It was the demand drag from tariffs, the GLP-1 weight loss drug narrative depressing spirits consumption projections, and a string of profit warnings that pushed the price-to-earnings multiple from a 10-year average of 24 down to 18. At 18 times earnings, with full-year guidance reiterated after Q3 results, institutional holders who had been reducing exposure on the dividend cut in February are now reassessing whether the exit was premature. The price action, 15% in weeks, appears to reflect that reassessment rather than new fundamental improvement. Revenue has stayed near the £20 billion mark for 4 consecutive years, and analyst forecasts show growth only in the low single digits through 2029. The recovery does not yet close the frame disturbance opened by February's dividend cut, because the cut itself signaled that management no longer had the confidence to sustain distributions at the prior level. A tariff removal on one product in one market is a meaningful input uplift, but it does not address the consumption trajectory question or the currency of the GLP-1 demand narrative. The position pressure that matters here is not whether Diageo recovers to its prior high. It is whether the February exit by income-oriented holders gets reversed by fresh institutional buying, or whether the recovery is running on short covering and positioning re-entry by tactical traders who see the PE gap as the opportunity. That distinction cannot be read from price alone. It requires watching whether the next earnings update restores the dividend growth trajectory, or whether management treats the tariff relief as a margin stabilizer rather than a reinstatement trigger. Which brings the question back to its domestic root. If even the FTSE 100's most globally recognized spirits brand could not protect its dividend from a demand-side shock, what does that imply for the dividend sustainability of companies whose cost pressure is structural rather than external?
BT Group's full-year results landed Thursday, and the market's 5% price decline on the day is the clearest expression of the underlying tension. The company rolled out fiber to more than 4.8 million premises, reached 2/3 of UK homes, and posted an EE 5G footprint covering 73% of the population. On operational metrics, the year looks like execution. On financial metrics, the year does not resolve. Reported revenue fell 3% to £19.7 billion. Adjusted EBITDA was flat at £8.2 billion. Free cash flow dropped 6% to £1.5 billion, and net debt edged up to £20.0 billion from £19.8 billion. The dividend was raised 2% to 8.32 pence, representing a 3.6% yield. Management's guidance, low to mid single-digit annual dividend growth until a BBB plus credit rating is achieved, then enhanced distributions, is the offer on the table for income investors. The problem is that the mechanism connecting capital expenditure to that outcome is not yet visible in the numbers. BT spent £5.1 billion on capex in the year just ended, and the payoff is projected as £2 billion in normalized free cash flow in FY27, rising toward £3 billion by the end of the decade. That trajectory requires the fiber subscriber base to convert at a pace and average revenue per user that the current results do not yet evidence. Income-oriented institutional holders who have been accumulating BT on the fiber build thesis are now sitting on a position where the build-out is nearly complete, but the monetization curve has not turned. That is the positioning pressure that drove the 5% sell-off, not a rejection of the long-term thesis, but a reassessment of how many more quarters the distribution has to wait. The Morrisons store closures and the Diageo Tariff Reprieve, read together, name the two mechanisms that determine whether BT's dividend path holds. If labor costs and regulatory levies keep compressing consumer discretionary spending, the household willingness to pay for premium broadband and 5G upgrades faces headwind, and BT's ARP assumptions become harder to achieve. If external trade relief or any easing of the employment cost burden frees up consumer bandwidth, the subscriber conversion arithmetic improves. BT's $20 billion debt load means there is no slack in the system. The credit rating threshold that unlocks enhanced distributions is the concrete variable to monitor. The specific benchmark is whether normalized free cash flow reaches £2 billion in FY27, as guided. If it comes in below that figure, the BDB plus pathway extends, the timeline for enhanced distributions moves out, and the income case weakens in real time. The recovery from Thursday's dip by Friday morning suggests tactical buyers saw value. Whether institutional income mandates follow depends on whether the FY27 cash flow number lands on the right side of that threshold. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.